Only got a couple more days to do whatever is going to be done, or maybe you hold your fire and wait it out. Bill, what's your plan?
Well, our plan is that we expect a second year of difficulty. So we are leaning into the things that we think are going to do well despite a market that is designed to punish the sins of the prior euphoria episode. So we're leaning into things that worked this year, and we think that will work off and on. That would include oil and gas and other valuable things despite the difficulty.
Hank, what's your plan? And let me just ask, everybody seems to think that you got to get away from all the stuff that's fallen. Meaning, is it all still a falling knife at this point? Is there any value in what's fallen?
Well, look, when you have leaders like the technology sector that led throughout the entire teens, it is very rare in the next cycle that those same leaders are the leaders going forward. So I would be a little bit wary about jumping into that. We're going to maintain our fully invested equity portfolios, maintain our heavily overweighting in healthcare, which really started to work in 2022, and we think will continue to work in 2023. But I've got 5 reasons why we should be optimistic investors, not traders, because we're going to have more volatility in 23 for sure, both in bonds and equities. But look, investors should be very encouraged that the Fed is taking the inflation mandate very seriously and does not want to repeat the same mistakes of the 70s, the stop-go policy. Furthermore, anytime you enter into a bear market, as we did in June and October, forward return expectations go up. Layer on top of that, since 1942, the 12-month returns after midterm elections have been positive. That's a lot of data points to hang your hat on. Also, sentiment is as sour as it's been in decades. That's a good contrary indicator. And so when you put this all together, I think there are reasons why investors should be positive. And as well, valuations are not all that stretched, particularly if you look at the equal weighted S&P 500. That's selling about 13, 14 times earnings, right, as opposed to the market weighted.
Here's the conundrum. There's been a whole bunch of people who've still been hanging out and living in the FANG stocks. They never sold. And they're trying to figure out, do I get out now after everything's fallen? Am I just taking my losses in lumps? Am I holding steady because maybe this stuff comes back? What do I do?
Hank, in my opinion, has one thing wrong in looking backward. Almost everybody's looking and saying, well, the market did really terrible. It's cheaper than it was. So therefore, it's going to do well because we rarely have 2 years in a row that are lousy. But if you look back, there's been about 4 or 5 major financial euphoria episodes. The go-go 60s and the nifty 50 era, the 2000 to 2003 era, the 07 to 09 fall in the real estate mania. Whenever you have a financial euphoria episode where people do stupid things with cheap money, the punishment has a tendency to last 22 to 36 months. So the problem is, and by the way, we like our Amgen and our Merck and that we own that have done very well this year also. But the problem is that this is more like 73, 74 and 0 to 03 than it is like these years when we've had substantial market drops. So the problem everyone has is, first of all, we've probably entered an inflation era. An era where dominated by 92 million millennials being a much larger group, too many people with too much money chasing too few goods. So what we want to do is we want to own oil and gas, land, businesses like Amgen and Merck that can, have virtually indispensable products like curing cancer and other things. So I've seen a lot of our friends and people that I would normally be making exactly the same case, which is, okay, stocks have gone down. It's a good time to be a contrarian. The problem is the meme stocks, the crypto, the SPAC IPOs, all these jokers that have been out there just shoving lousy investments on people for 4 or 5 years. And Andrew, the answer to your question is he's absolutely right. You can go back and look at the top 10 holdings at the end of each decade, and they almost never are a good idea the next 10 years.